So how should you be investing based on what Ben Bernanke said today? For some answers on that, we turn now to Jim Paulsen. He's Chief Investment Strategist at Wells Capital Management. Okay, so we saw, Jim, how the market responded to all of this news. What should individual investors be doing? Should they be making changes in their portfolios, whether they own stocks or bonds?
Well, I've been on the view that we'd reach, the S&P would reach 1,700 this year, and about a month ago we did that, Susie, and I'm not inclined really to raise that target for this year. I think the stock market has entered a broad trading range, let's say somewhere between 1,700 for the rest of this year perhaps. It's going to have to digest rising bond yields, as Mark just said. I think they're going to continue to rise through the balance of this year. The 10-year yield might end the year closer to 3%. And it's going to have to digest the end of quantitative easing by the Fed. But I think the economy is going to continue to prove better than expected, keeping stocks from falling very much. So I would take advantage of this trade range, if you will. Number one, make sure that you're down, not as exposed to bond prices as you've been perhaps, because yields are going to go higher and bond prices are likely to fall. And within the stock market, take advantage like days like today when it really comes down to maybe add a little bit to stocks that you'll want to hold into 2014. And that would be, to me, some more of the cyclical sectors that are more sensitive to better economic growth. And when it rallies, if it rallies over the next several months, maybe take advantage of the strength to sell off the bond-like stocks that are real sensitive to interest rates or defensive stocks, and to plow that money back into more economically sensitivity. I still think the bull market's intact and is going to go higher again next year.
So you believe, as Mark did, that a positive economy is going to trump, from the market's standpoint, is going to trump the effects of rising interest rates. That's basically your view here.
I think so, Tyler. I really do. I really think if you go back a couple of years when we were worried that the Armageddon was coming and the world was going to end, we would have loved to have today. In some way, today, to me, should be a celebrated milestone rather than some scary event. Because really what happened today was that even the Fed now, which has been very worried about the economy, is admitting that it is indeed getting strong enough that it can start to back off from stimulating so hard. That's a great thing. That means it can stand on its own 2 feet, and that's great longer term for equities.
But as much as you're saying all of this, investors are still scared by seeing these triple-digit gains and triple-digit losses like today. Markets selling off on what presumably is a good news day. So is there a way that individual investors can benefit from this volatility, play with it?
I think so, and I think that's what I'd look. I'd keep your eyes on not necessarily day in and day out or month in and month out. Look where you are from a year ago, and you're still making good progress. And on days like this, rather than fear, I'd go hunting for bargains today. I'd look at maybe like the technology stocks you've been wanting to get into, or maybe some of the beat-up industrials, and to take advantage of people wholesale dumping those today and buying on that weakness in anticipation that maybe it'll oscillate over the next several months, but a year from now I'll be happy I bought those.
So you've mentioned a couple of categories of stocks where you might be doing some cautious or maybe even a little incautious buying. Technology, cyclicals, industrials. I assume you mean the big equipment makers, the CATs and so on and so forth, and other industrials. You mentioned a moment ago, though, that you would lighten up on stocks that perform like bonds. What comes to mind there would be utilities and telecoms. Am I right?
Yeah, that's right, Tyler. I think both of those pay a high proportion of their earnings out in dividends every year, and they're a lot like a bond, which just pays a constant coupon payment every year. So when interest rates move, they really affect the performance of those stocks. And utilities and telecoms are getting hit in the last month or so as bond yields have moved up. If bond yields continue to move higher, those stocks are going to underperform other equities. So I would take advantage of days when they rally to maybe lighten up your exposure there and to move away from there, because I think over the next year or so, those are not good areas. I think another popular index that people plowed into is the dividend aristocrats, the highest paying dividend stocks, and I would move away from that and move to more economic sensitivity.
All right, lots of good information. Thank you so much, Jim, as always. Jim Paulsen, Chief Investment Strategist at Wells Capital Management.